Most recently, the spike up as well as the correction down had a lot to do with tariffs and Trump implementing tariffs, and then those tariffs being questioned by judges, and that's kind of in limbo. And then there's a new thing with whether or not China is sticking to their agreement. But the key is global trade really is what gives the global economy the robust and solid world GDP that we've seen recently, and that's what keeps the clocks going, so to speak, the economic clocks of growth. And so that's why gold has been so robust.
Gold prices climbed on Monday as an escalation in the Russian war in Ukraine, and U.S. President Donald Trump's fresh threat to double tariffs on imported steel and aluminum prompted investors to seek refuge in safe haven bullion. Renowned technical trader Gary Wagner discusses recent gold price movements and their broader implications. Despite being off its peak, Wagner believes gold's performance remains impressive, especially considering it was trading around $2,670 just last November. He attributes this sharp rise to heightened uncertainty surrounding U.S. leadership, Trump's proposed tariffs, and global trade tensions, which have historically driven gold prices higher. As the July 9th tariff deadline looms, gold prices are likely to remain volatile. Investors must weigh the interplay of geopolitical risks, U.S. monetary policy, and trade developments. While central bank buying and retail demand provide a floor for prices, the potential for dollar strength and market corrections poses risks. For now, gold's allure as a safe haven asset endures, but navigating its fluctuations requires a steady hand and a long-term perspective. In his assessment, Wagner explains that although inflation hasn't spiked as feared, the uncertainty from political shifts continues to support gold. He views $3,200 as a key support level, warning that a break below could signal the end of the bull run. This range reflects current market confidence amid uncertainty, but may shift with changes in fundamental factors. Analysis of gold's inflation-adjusted price patterns indicates we may be in the early stages of a major bull market. After breaking through key resistance levels, gold is consolidating before potentially continuing higher. Using the Hunt volatility funnel methodology, which identifies volatility constriction patterns before major moves, gold shows clear signs of a significant breakout. The inflation-adjusted interim target suggests a move to 9.9, with long-term potential for much higher levels. Before we dive into Gary Wagner's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market.
Gold's doing some interesting stuff, but it's not out of the realm of what I believe were likely realities after touching the record highs that it did and then coming down. I still think the performance in gold has been stellar, although it's well off of what we saw as record highs. The most recent high being around 34.65. That is this top here. That occurred on May 6th. From there, it went to a pretty severe low, roughly 31.80, and then has rebounded quite well. So considering everything and really considering the massive run that gold has had, even if you go back to as early as November, gold was at $2,670. I mean, just fathom that at $2,670 in November, and here we are months later, not years later, and we're looking at a robust troy ounce costing well over $3,000. Right now, pretty much at 3,300 in futures, so spots can be right around there. That's phenomenal performance. That doesn't bode well for other events because gold tends to run to extreme levels during periods of uncertainty, geopolitical unrest, unknowns being present within the economic environment. And so for those reasons, I always feel better when gold prices are lower, but as a technician and an enthusiast of gold, I believe that it is well priced and properly priced, Kai. We had a lot of unknowns in the marketplace in terms of leadership in the United States. What we did know is the policies of the former administration in many instances would be done away with, and new economic and political strategies would be evolving with President Trump. And so when you've got that type of dramatic change, it raises a level of uncertainty to a very, very heightened state. And that is what we saw. Realize that the geopolitical conflicts that are embedded within the world have existed for a couple of years. They're still in the news cycle. It's still a terrible situation, not only in the Middle East, but Russia and Ukraine. But that's not what seems to be moving gold recently. Most recently, the spike up as well as the correction down had a lot to do with tariffs and Trump implementing tariffs, and then those tariffs being questioned by judges, and that's kind of in limbo. And then there's a new thing with whether or not China is sticking to their agreement. But the key is global trade really is what gives the global economy the robust and solid world GDP that we've seen recently, and that's what keeps the clocks going, so to speak, the economic clocks of growth. And so that's why gold has been so robust. Specifically, the tariffs and implementing the tariffs had so many unknowns that inherently it would really ratchet up the level of uncertainty as how it would affect the economy. Specifically, inflation, it was thought that it would really drive inflation higher. We're recording this on Friday, and the Bureau of Economic Analysis came out with the most recent personal consumption expenditures, PCE, which is the preferred inflation index of the Federal Reserve. And it rose by an annualized rate of 2.1% in April, down from 2.3, and actually came in under the consensus estimates. So rather than seeing a huge uptick in inflation, as many economists believe we would see with tariffs being imposed, because the tax adds costs and added costs is inflationary. In fact, we're not seeing that. And so that's an interesting facet that we're just trying to digest to make sense of. Well, as we've just talked about, inflation hasn't spiked as hard as we thought, but the possibility of that occurring further on down the road is, to me, a main contributor that's keeping the support level above 3,200 and 3,300. I think that if it does break below current pricing, it's at a fairly critical point. It could go as low as 3,200, but I see 3,200 as a level of major support that in fact should hold, and should hold if we're still witnessing a bull run in gold. A break below that would signal that we might have seen the end of that bull run and move from a very bullish market sentiment to a bearish market sentiment. Because we both know, Kai, that I think Paul Volcker put it best. He goes, trees don't grow to the sky. They never have and never will. He was talking about interest rates. But if we can reflect that and kind of carry the analogy to gold, gold doesn't continue to gain without any resolution or without the ability to find a base and then not to move to higher ground. We actually see gold at a mid-range because we have a much higher high than is currently trading, $200 above current pricing. We've got solid support, $100 and $200 below. So we've got a very wide range in terms of 3,000 to 3,500, in which gold can stay in that range. And that's what's most interesting to me. If you look at the chart that I brought up, and we look at 2,500, this is back in July of last year. So 25 to 3,500, $1,000 move, but you had a fairly strong move up, very, very shallow corrections. Moves up, shallow correction. What has been predominant in the market up until really this last couple of spikes, where it moved to 3,470 and then down to 3,200, you had huge upside ticks and very, very shallow corrections. That wasn't the case on this last correction. It was sizable, but compared to what we've seen recently, gold seems as though it's found a footing, because it's not near the all-time record highs nor near the recent lows. It's kind of trending water right in the middle. And that, to me, says that it's kind of found a foothold at current pricing. It could go $50, $100 higher or lower, but it's comfortable in this area. No one's able to really bang bang the market down without some traders believing there's value and they buy the dip, or move it up to 3,500 and other traders say this is time to hammer it and pull profits on our long position. Right now, it seems as though it's at a range where traders believe they're comfortable with where it is, and they're not looking for these big spikes up or spikes down. That could change at any time as fundamentals change, but at least this is the first time that we've seen it move kind of into a mid-range between recent highs and recent lows.
In the interview, Gary Wagner notes that the US dollar index has declined from 110 to 98 since January 2025. He emphasizes this dollar weakness as a key driver behind gold's rally, citing the strong inverse relationship between the dollar and gold. Highlighting a shift from tradition, Wagner dismisses seasonality and attributes gold's rise to fear-driven sentiment. He notes strong trading volumes backed by ongoing central bank accumulation. The global average is roughly 20%, but there is a divergence between developed markets and emerging markets, according to Goldman Sachs. Central banks' purchases of gold have increased fivefold since the invasion began, and demand from governments is expected to remain high for some time to come. Furthermore, Wagner describes gold as having gone mainstream, citing consumer access and professional interest. For new investors, Wagner advises entering carefully and gradually, while noting that many large holders are now taking profits after the significant run-up. Let's get back to the interview.
The dollar index, and I'll go pull up a chart to illustrate what I'm talking about. Let me just compress it. If you go back to January 2025, the dollar index is at 109.95. Let's round it up to 110. It went from 110 down to an intraday low. I'm looking at a daily chart, I believe. Yes, a daily chart of 97.96. I'll round that up to 98. So we've seen the dollar in relationship to the basket of currencies it trades against in the dollar index decline in value by 10% this year. That's a tremendous drop. And of course, this is a primary cause for gold running, because when gold is paired against the dollar and the dollar is losing value, there's 100% correlation between dollar weakness and gold strength in the reverse. And so this is what we've seen. Then you add bullish momentum from traders bidding the precious metal higher. You get a double whammy, so to speak, and that's why we've seen gold move to these levels. The one chart I'll pull up right now is where I think we could be heading. And the first thing that we'll note is that we have had a series of highs, 3,500 here, 3,444 here, and 3,349. So we've had a series of lower highs. If we look at this bottom and this bottom here, we've had a series of higher lows. Series of higher lows, a series of lower highs is a flag formation. This looks like, or appears as though it might be, a bull flag, but we will have to see as it gets closer to the apex and breaks. It can break either way. Typically, in this kind of a market pattern where we've had strong moves up and then consolidation, and the consolidation is this exaggerated high 3,500 down to about 3,100, $400 price swing. We could see gold, if it maintains this bullish momentum, I think move as high as 3,600 and do that by the first or second quarter of next year. Really high back in April here, but it's been very, very solid volume. Of course, it's been the down volume days that have drawn the attention. Beginning of April, 20th, 21st of April. But volume's been exceedingly strong. You've got to realize there has been consistent central bank accumulation. That's been ongoing. There's been tremendous trader awareness of gold as not only a strategic asset, but one that's been outperforming many of the other asset classes. Of course, particular stocks have had stellar performances, but there's a reason they call it the Magnificent Seven. It's 7 stocks out of hundreds of companies. So consider gold as a single asset. It's performed very well. It's in the eye of professional traders. Central banks are accumulating, and consumers can buy it at Costco. It's pretty mainstream right now. I've gotten any of my points that I really think are important for the trader novice, or just those thinking about getting a toe wet in the water, especially for those that haven't accumulated. This is a tricky time. How do you buy gold at $3,300 an ounce when it was at 2,500 less than a year ago? Uh, the answer would be carefully and slowly, is what I would say. Um, Strategically, you would probably want to start smaller than before this run up. For those that have been accumulating, they're going to start layering out. They're either going to liquidate or buy in much smaller quantities if they were on a program where they were accumulating on a set level, every month, every 6 months, or something like that. I do know that some of my larger clients that were large physical holders um, actually did a lot of liquidating over the last month. And I can't fault them. I mean, if you accumulated a lot of gold and then watched it move up to 32, 33, see it at 35 and then go down. He was being interviewed and they said, let me ask you, we watch all of these investors and traders, and some make money and some don't, but you seem to consistently make money when others don't. How do you do that? He goes, well, I always sell it. I always take profits. I don't know. And it was that kind of ideology that I think we've seen in the market, and we certainly saw it in the price.
Goldman Sachs predicts that gold will rise to $3,700 per troy ounce by the end of 2025, driven by a renewed appetite from investors and a long-term structural shift in demand from central banks. As gold holds firm within this range, will the next global shock send it soaring past resistance or mark the start of a deeper correction? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.